Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, 𝗖𝗣𝗜 𝗖𝗽, and I'm joined by my co-host, August Biniaz. We have another great show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and expert guest speakers. Our mission is to empower investors to earn passive income through real estate investing. We're really excited today because we're joined by Nicholas Diamond. A little bit about Nicholas. He's an associate director at 𝗖𝗣𝗜, where he is responsible for structuring and originating the firm's platform of mortgage banking products throughout the US. August and I believe this interview with Nick will bring great value to active and passive passive investors to learn about the nuances of debt financing for commercial loans. Thank you for being here today, Nicholas.
Welcome, Nicholas.
Happy to be here. Thanks for having me.
Awesome. Great. So why don't we just start off by you telling us about your background and your start in real estate, please?
Sure. My first job in real estate was I worked at an investment bank called Credit Suisse, which was a Swiss bank. And in New York, I was in the real estate and finance group, and I started out as an analyst, and I was in the CMBS group. So what we would do is we originated commercial mortgages all across asset classes, hotels, multifamily, office, retail. We did a lot of shopping malls. So we had an origination platform, and then I worked on the structured finance platform, and we would actually take all of those mortgages, hundreds of them, and turn them into a trust, and we would sell bonds called CMBS, commercial mortgage-backed securities, to investors like mutual funds, banks, insurance companies, anyone that was looking to yield on different level of bonds. So they would be we'd get them rated at the agencies, starting at AAA, which are sort of the safer bonds, all the way down to not rated or below investment grade bonds. So we did that. That was my start. I did that for about 8 years, and then left the business and for about 6 years, and then came back and got into the agency financing, which is just mainly multifamily. So, and I've done that at a couple of firms, and now I'm with 𝗖𝗼𝗜. Yep.
Great. And the bonds that you're talking about and packaging, the kind of the loans, was that a pre 2008 financial crisis, or was that?
It was. It was. So okay. Yes.
Tell us a little bit about that. Was any of your loans kind of involved in that issues that?
So it's a good question. And so a lot of the troubled issue, a lot of the sort of the headline that we hear about was really in the residential section. So there was a big boom in the single family business, and and the security, it was the same model where they took mortgages on single family homes on residential and then did the same securitization process, sold the bonds to investors. That's where the trouble really happened. On the commercial side, while it still got very aggressive, and there were some defaults and losses on the commercial side of that business, it wasn't as bad as the residential. So we weren't at fault. It wasn't our fault.
Right. Yes.
For sure. Okay, great. So that brings, our next question.
Yeah, Nick, maybe we can discuss what differentiates a commercial loan to a residential loan.
Sure. So, I don't do residential loans, but I have borrowed for homes before, so I'm familiar with the process. And the way really it works is the difference is a residential loan is a mortgage, which is usually guaranteed by the borrower on just a single, family, or really up to 4 families. So I think Fannie Mae and Freddie Mac define it as 1 to 4 family for a sort of a single family residential mortgage. And so you take a loan, usually 80%. And the same thing happens. The banks will then usually take those mortgages and sell them to an investment bank or some sort of aggregator, and then they get securitized. And that's just really part of the cycle of how banks can sort of then recycle capital and lend money again. It keeps the economy going, the flow of capital. Same thing happens in a commercial loan. Commercial loans are generally non-recourse, which means that the borrower is not personally liable for that loan, but a similar process. Usually underwrite a transaction. You make the loan, up to 80% generally. And then those loans are usually sold or securitized. Sometimes they're held, if they're balance sheet loans, they're held on the bank's balance sheet, but it's a similar process. But
okay, right on. Thank you for explaining that.
Yeah.
Now, my next question is, there are a few terms that are regularly used in commercial financing. So let's kind of try to make sense of some of them. Let's differentiate between the types of loans that exist for commercial finance. So there's agency loan, bridge loan, vendor take back. Can you please explain what each means and how commonly they are used in commercial financing, please?
Sure. So yeah, there are lots of different options in commercial financing. So you have, I don't know what a take back loan is, but or that term, but you generally have you have banks, you have non-bank lenders like who I work for now, which we're not a bank. We don't take deposits from consumers, but we are a financial institution. So we have other methods of financing our businesses. So you have agencies like Fannie and Freddie and HUD, which rely on lenders like us to originate products for them. And they really act as what I like to say is insurance companies. And then you have balance sheet bridge lenders, which which we also do, but then there's lenders that just focus on short-term bridge financing.
And quick question for you, Nick, when you say you do, does that mean you broker those types of loans, or your firm actually has access to capital, which then lends it out as a bridge loan?
So in my case, Lumen is the direct lender. So so we are the lender. So we originate loans for our balance sheet, which is our capital. We originate loans for Fannie and Freddie Mac and HUD, which again, we originate for their platforms, and then we service the loans. So we're what's called a seller servicer, and then investors buy those loans, and so we can then go and make new loans.
Got it. Quickly on the bridge lending part. So let's kind of break it down. So bridge lending is kind of private lending as we call it here in Canada. It's separated into your good old neighborhood guy who lends you some money on a property you want to buy, but it also happens on the institutional side. Could you differentiate those two, please, if you may?
Yeah, it does. So bridge lending, there's bridge lenders that that's all they do. And then there's sort of financial firms that also have bridge lending available to them. But, bridge lending is the way it works generally is a shop will, set up warehouse lines with big money centers, big banks, and then they have to post a certain amount of leverage, a certain amount of, what they'll do is they'll get a warehouse line, they'll originate a loan, and they'll get leverage for that loan. So maybe up to 60, 70% of that capital, and then they have to fill in the gap. If they're doing an 80% loan and their warehouse line goes up to 60%, they'll only need to pony up 20%. And then they post, and then that allows them to sort of leverage up and do a lot of bridge lending. That's sort of the general model of your traditional bridge lenders. Does that answer the question? And then,
for sure it does. And then the vendor take back mortgage is where the seller actually finances the loan. The seller either has clear title on the property or in some form or way they're the financier of
I got it, understood. So seller financing.
Seller financing, exactly.
Yeah, sure.
Is that, you see that at all in the commercial space in multifamily?
You do. I mean, I don't see a lot of it on my side. I mean, we're, just based on, our client base and what we're out, it's kind of the business we're looking to do, but it happens. A lot of my clients have certainly taken advantage of good seller financing. Sometimes it's a great option if a deal doesn't pencil out for, say, an agency loan day one, because sometimes things don't pencil out, and sometimes the seller will say, hey, I'll give you, put 10% down and do your business plan, and then in a year later we would come in and then maybe take it out after the person went in, executed their business plan, their value add, whatever they're doing, and then they'll refinance, pay back. But yes, I've seen it for sure.
And there's also a possibility of the buyer actually taking over the seller's mortgage as well. That
assumptions.
Assumptions.
Assumptions are very common. Yep, assumptions are common if a seller has very good terms, maybe had recently refinanced the property or purchased the property, and it's got appropriate debt level on it. Then yes, assumptions. We do assumptions all the time.
Great.
It happens. Yeah.
And a follow-up question to bridge lending, if I may. Sorry, Ava,
Please.
I'm very excited here asking a lot of questions.
Please. No, that's great.
Just a follow-up to the bridge lending question. So, let's discuss risk. And risk mitigation is one of the crucial parts of debt financing, right? Is to find out, hey, if the money they're lending out, what level of risk is associated with it. Sure. For example, the debt. For example, on multifamily projects compared to ground-up development projects, a lot of time there's a misconception that ground-up development projects, banks are very open to lend to them, but there is lots of risk associated with the ground-up development projects, and a lot of ground-up developers, initially at least, go through the bridge process to borrow somebody from bridge lender to get the property to a certain stage before they switch it to conventional type of mortgage. Is that common? And what is the reason for that when you compare it with a stabilized multifamily cash producing property? If those two projects come to a lender, they're looking at a ground up development project and they're looking at a stabilized cash flowing multifamily project. Why is there more risk associated with the ground up? And why do the most, A lenders, as we call them here, or agency lenders, then, refer that to a bridge lender, and then at some point then get back on? Explain that dynamic, please.
Yeah, sure. So, I would say just from ground up development versus buying something that's stabilized, the risk associated with that is really just, a development project needs to be developed, right? And so usually takes a couple of years. Things happen over time, laws change, there's cost overruns. So generally, development projects are looked at a little more risky, of course, versus buying something that's stable. It's already built. There's usually people in the property paying rent. So it's easier to finance. And obviously you get more leverage. Usually with construction deals, you don't get as much leverage. You have to put more equity into it to get them going. But once properties, so that's really the risk factor that a lender would look at, evaluating to, maybe lending if they had a choice on lending one versus the other. And then, but on the construction side, once projects are developed and once they start to stabilize, and we do this along with a lot of other lenders, but then what we'll do is we'll do a bridge loan to take them out of their construction loan, because construction loans usually have a 2 or 3 year window, and then the financing is usually a little more expensive. And then so we'll put a bridge loan on it, and what we call it is like a bridge to agency. And so it'll allow them to pay off their construction lender, maybe some preferred equity, some more expensive capital that they've, right? Because it's a riskier project, so you have to pay more, more returns to your investors. So we'll usually provide enough equity to sort of take that equity, take the construction out, pay off expensive equity, and then let them stabilize for 12 to 18 months with a bridge loan, and then we'll take it out with a permanent agency loan or some sort of permanent financing product.
Interesting. And I'm curious, what is the typical LTV on a ground up development construction?
So banks, banks are around 60 to 65%. We have a construction product at Lumen, which is we can go up to 75%, but we're more expensive than a bank. So a bank might be, I was going to say LIBOR. The LIBOR is a thing of the past now. So now we're in SOFR, but it was like a bank on an experienced borrower might be L plus 300 or something like that. And whereas we're a sort of a higher leverage lender, we'll go up 75%, but we might be L 525 or 550.
Right.
So it just depends. And then you have lenders out there that will do 90% financing, and they're going to be L 900 or 10% money, but they'll get you up to 90%. But at the end of the day, you have to look at the numbers and see if it works. Sometimes it makes sense for a sponsor because they don't have to put as much equity in. They don't have to raise as much equity because equity is expensive.
Yes.
Yeah.
So-
Sure.
And then when you talk about 300 or 900, you're talking about basis points.
I am. Yes. Yeah. Thank you. Yeah. So at like 9% over,
Yes. No, for sure.
Nice, nice.
Perfect.
Now, Nick, where does funds for a loan come from? Does it come from the bank? Does it come from the government? Where is the origination of funds in commercial loans?
Especially in your case, where
Yeah.
you said that you guys, your firm actually has funds to lend. Where does those funds come from? Does it come from private equity? Do you guys raise private equity for those funds? Like some lending firms do such thing, like we call them mortgage investment corporations. Talk to us. Where does the actual funding come from? All these different types of loans that you mentioned.
All different types of loans. So it's a great question. So I mean, we as a big financial services firm. I can speak for a company like us, and we have a lot of similar, competitors that it's the same business lines. We have firm capital, where the firm allocates X amount of dollars for us for different business lines, but then we also utilize warehouse lines, and that's when we go to the JP Morgans of the world, the Wells Fargos, the big banks. And they provide warehouse lending lines. And that allows us to sort of everyday close loans, and then until we securitize them or sell them. And then once we do that, we pay down that line and we have that capital available again. But, other companies like REITs, they if they're in the REIT business, they can, issue stock to get money. So it just really depends on the business line. But the warehouse line and the securitization model exit is really how the money sort of recycles.
Got it. And now when you look at it, on the bank level, do banks then go to government and get funds from the government? The same model you just explained, but just on a higher level?
Yeah. So if you're Wells Fargo, you're borrowing money from the Federal Reserve at nothing. And then, you're lending at something, much higher. So banks generally have the cheapest form of capital because they're going right to what we, joke is mom and dad, for a loan. And it's usually, whatever the Fed funds rate is basically what they're borrowing at, some sort of overnight rate. It's been a while since I've gotten into that type of finance, but that's generally how it works.
Sure.
Awesome.
We're just talking about generally.
Awesome.
Yeah. So we can't borrow from the Fed because we're not a bank.
You're not a
So
bank.
our capital is more, generally more expensive on, just for our everyday financing businesses. So we don't have that cost of funds, but that's how it works. But we go to them for loans.
But a lot of products you provide, banks don't, because they don't go as high as LTV or,
That is correct. That's right. And so we do utilize, most of our business is Fannie, Freddie, and HUD. And
cool. And
yeah.
that's actually my next question. Let's discuss Fannie, Freddie,
Yeah.
and HUD, and if you can, talk to us about what they are.
Sure. Yeah. So they're so I'll talk about Fannie and Freddie first.
Sure.
So they're both quasi-governmental agent, outfits, and their mission really is to provide liquidity in both residential and commercial multifamily. And so what the two agencies do is they each have seller servicers. They have a network of lenders like us. You have to have a license. Not anyone can do it. You actually have to buy a license from a company that's either in business or has a license and they don't use it. But I think at this point, they're all being used. So what that allows is it allows us to go out and originate loans on behalf of Fannie or Freddie. And we typically underwrite the loan. We do all the due diligence, and they provide parameters on how that gets done. And we have to follow what's called a guide, which is just their rules on what needs to be done, and that's it. And then we deliver the loans to them. And then we service them for the life of the loan. So the borrower, once we close the loan, and this, I can walk you through Fannie Fannie, the way it works is we once we close a loan, we take that mortgage, we turn it into a security, and our trading desk sells it to an investor. So one loan. Sometimes Fannie buys it, but most of the time it's banks, insurance companies, mutual funds, hedge funds, whatever. So they'll buy that mortgage for the yield. With Freddie buys all of their mortgages, and then they do their own securitization. So Freddie pools all their mortgages and then issues bonds based on all of those mortgages. So they do a little bit different of a model. And then HUD is a little bit different. They really just act as the insurance company. Their securities are called Ginnie Mae, but it's similar to Fannie. You originate a loan, you close it, and then you turn that mortgage into a security, and that security is sold to an investor.
All right. Okay, great. Thanks for touching on that. That's awesome. Okay, so let's chat about the difference between using a broker rather going directly to the lender. Yeah. What are the benefits of using a broker compared to going directly to the bank?
Great question. So brokers really offer a client sort of a broad range of lenders. So brokers usually have a lot of relationships with not only someone like myself, but someone who works at an insurance company who allocates money for insurance, for someone who's at a CMBS lender, someone who's at a just another money, another different type of lender, private lender, maybe REITs, things like that. So they usually, brokers can go out wide to the market with deals and usually help facilitate, sort of the best execution for a transaction based on what the client wants. So they can add a lot of value in commercial real estate. With multifamily and agency lending is really more of just a relationship business. I don't mean I have a lot of broker relationships and clients who we do deals with, and they bring me a lot of deals. And I don't mean to disrespect their model, but really the agency model is really a direct relationship. And the reason why is because the agencies dictate pricing and they dictate the process. So there's not a tremendous amount of difference between my loan and Capital One's agency loan and Berkadia's agency loan and Walker and Dunlap and Greystone and all the other agency lenders out there. We all have to follow the same rules and we all get the same pricing. Now, there are differences in relationships internally, whether you're a bank lender like a Capital One versus a Lumint, which we're a private lender. We don't report to bank regulators. So I like to tell my clients we can get a little more creative, if you will. We just don't have the same oversight. So it's usually if you're just a multifamily borrower and you love Fannie and Freddie or HUD, you really have a banker or two or three that are direct. You don't really need to hire a broker, pay a broker to go out and get you an agency, go to 4 different agency or 5 different agency lenders, because at the end of the day, that loan is going to look the same because they're all going through the same process. They're all going to get generally approved with the same people at the agency level. Mm-hmm. So multifamily agency lending is really a direct business. That's
with the caveat that the borrower has an already existing relationship with some sort of agency lender. That if that relationship is non-existent, then it probably makes sense to go through a broker.
If they don't, yes, then they can go through a broker. But usually, if you are a multifamily borrower and you've done 1 or 2 agency deals, you understand how it works, and you have. And by the way, I do agency deals for a couple of clients who they come in through a broker, but that's a broker that they've had a 25-30-year relationship with. So that's their guy, that's their person. So they're going to, no matter what, and they understand that they don't have to, but they do it because they trust them. And the broker also sometimes does most of the heavy lifting. right? They do the questions, the setting up the inspections and the paperwork and et cetera. So they do add value.
And just quickly here, so just to understand your position here, so you got brokers who are basically freelancers and go out there and try to get the debt from private lenders, from agency, anywhere they can, and they package up the application and then send it to either their connections or people that they know. There's the banks that the borrower can directly go, the lender, let's call it, the borrower can go directly to. Yourself, are you somewhat a mixture of both, where you are a broker of a private lender, but you talked about also where you could be the conduit to agency? Are you somewhat of a particular lender's broker, but you also broker deals?
So we're a direct lender. So we are the agency lender. Okay. So you would, if you're buying a multifamily and you want financing, you want Fannie or Freddie or Bridge, you would come to me. We're your lender. It doesn't get brokered out. Got it. I typically don't. I mean, we don't have a CMBS platform. So I have in the past had a client who had a retail property. I don't finance retail. So, but it was a client that I have financed several apartment buildings for. So I said, I'll help you get a CMBS loan. So I sort of brokered that to someone that I know that does CMBS lending. So in that sense, yes. But if somebody wants a Fannie, Freddie, HUD, or a bridge loan for a multifamily deal, or even a construction loan, it's in-house. That gets done through me. I typically wouldn't broker that.
Got it.
All right.
I don't consider myself really a mortgage broker. I'm a mortgage banker. We have our own products to offer.
Great.
Right on.
Great.
Yeah.
All right, Nick. So let's go on to the next question. We commonly see this 3 + 1 + 1 term of a loan. Can you explain what that means, please?
Sure. So bridge lending in the agency space, it's pretty common to have a 3-year initial term. So that means your loan it has a term of 3 years, but we allow two 1-year extension options on the back of that. So if you need more time, your business plan took a little bit longer than you thought, you're not stabilized, you haven't achieved the rents that you need to really maximize your refi and cash out what you need to cash out to pay all your investors back, et cetera, and own the property. But yeah, so that's it. So it's a 3-year term plus 2 1-year extension options, and there are fees associated with those. So you do have to, we as a lender, we want to give you the option. We want to refi you in 3 years, but if you need longer, we give you that option for an extension.
So quick question. So we come to you, we want a loan for a multifamily project. We get the loan at the terms and the interest rates that you provide for a 3-year term. And then just to have the +1 option, do we pay an extra fee just to have that in place, or only when we engage it is when we pay?
Only when you use it.
Only when you.
Right. It's called an extension fee, and you pay it at that time. At that time. It varies. It's usually like a quarter point or something like that.
Got it. Okay. And is it since we got that type of mortgage at the beginning, does that guarantee us the same interest rate as we went in for a 3-year term on the +1, and then also the subsequent +1?
So there are sometimes resets, but generally it's usually fixed for that potentially 5-year term. So your spread would stay the same. And it's a good point. Bridge lending is generally floating rate. It's not fixed. There are lenders out there that will do fixed rate bridge loans, but most lenders offer some sort of variable financing, floating rate financing.
Got it.
Which is what we do.
So it's not really on the interest rate, rather on the agreement or the term of the loan, where it could be extended if needed.
That's right. So usually we'll have a fixed spread of, 350, 375, and it's over some sort of benchmark, which now SOFR has replaced LIBOR. And so that interest, that variable, so your spread is fixed, and then you have a floating rate component. So your rate can go up, it can go down. depending on where that benchmark is moving with the market.
In Canada, we call it prime. So it's prime +1 or prime plus X amount or.
Yeah.
Understood. Yep.
Yeah. Okay.
Yeah.
Great. Awesome.
Yep.
All right. Okay. So let's discuss, next question. Let's discuss loan application process for syndicators, or as we like to use the term, real estate private equity firms.
Okay.
Are lenders more reluctant to lend to syndicators as it's the equity as the equity is being raised rather than having the equity in place?
No, it's very common in this business. Not more reluctant. Usually, lenders want to have an understanding of how the deal is going to close, where the capital is coming from. But it's very common that that people raise money from a syndication process, and sometimes it's through firms like yours. Who go out and through their network and in their investors and raise money. And sometimes it's just, friends and family, where they just have a network of 50 people that they go to for every deal that can write checks. It's the same process. But yeah, I mean, we usually, when you kick off a deal at application, you like to get a sense of the organizational chart. So you know who's in the deal, who are the players, things like that. But it's not, in our business, it's, most of our, I would say majority of our clients are sort of, middle market investors that need to go out and raise that capital. They're not institutions that just pay cash or whatever, write the checks themselves. So it's very common.
No, as a golden nugget to our viewers, maybe we've been talking more broadly about kind of the processes and terms and what have you. But you personally, when an application comes to you, when a file comes to you, and it's, let's say, from a group that is a syndicator, what are the steps aside from the regulatory and common steps you take? Are there particular steps that you take? For example, reaching out to your personal network and say, hey, there is CPI Capital, they're a private equity, real estate private equity firm. Do you know them? Have you ever done deal with them? Are there due diligence that you do that's aside from just the application itself for you to get to know the firm and kind of give us the inside of inside your mind and the steps, like the secrets, the steps you take before, starting even the process for initiating a loan?
Sure. So it's a good question. So, I mean, every deal is different, but what you try to flush out up front is every deal has usually a key principal, and then they have LP investors. So really non-managing members who could be, 70% of the equity or 80% of the equity or 90% of the equity, but they're in an LP position. So we try to focus on who are the guarantors and the key principals in the deal. And that is usually defined by really two things. One is someone owning 25% or more of the borrowing entity, and or as a key principal doesn't need to have 25% ownership, but they need to control the deal. So someone who's got control or who's vital to the operations of the business. So that's how we define it. So we really like to just get it, understand who they are, sort of what their net worth liquidity looks like, what their real estate schedule looks like, experience, right? Because my job is to then sell it to my credit team to eventually get the deal approved. So we want to make sure that we have, a sponsor or sponsors that are, that have a good story and, why we should give them, millions of dollars and to finance the deal. So, but yes, we'd like to understand who they are, but usually we don't get involved in the LP side because of what I said, unless one of those LP investors controls, one individual controls 25% or more of the borrower, in which case it's not an issue, but they have to be underwritten. And so that means that individual has to provide a personal financial statement. We have to run credit, a real estate schedule. We would treat them like we would one of the general partners or key principals.
Okay, quick follow-up question. Don't expect you to know the answer to it, but you might. If that investor that you just mentioned, that's part of the LPs, let's call it an investing entity that's alongside the other LPs and owns more than 25% of the total equity. But that entity is, let's say, a Canadian entity. Do you have processes in place to approve a Canadian entity's financial assets or net worth?
We do. There's processes in place, and we finance foreign investors, Canadian investors. We have, I've done deals where we've had KPs in Israel, things like that, and other countries. Yeah, I don't recall exactly what we need, but we need information. But sure, it's not an issue.
Right on. Now let's discuss key principal. Is this term just a fancy way to say loan guarantor? Like when a young kid, wants to buy a car, but they have to get their parents to co-sign on the loan.
Good question. So it's not, so a key principal doesn't necessarily have to be a guarantor. So the guarantor, the way we, in my business, the way we, and I guess most lending, the guarantor is really the person who is signing so all our loans are non-recourse loans, but we do have what we call bad boy carve-outs. And so we do require a guarantor who has net worth and liquidity that meets the requirements.
And the bad boy carve-outs is in the case of fraud or unscrupulous activities.
Exactly. Yep. So, if you own a property and it goes downhill because the city built a highway in front of your property and all of a sudden tenants left and you just can't rent it out, and you come back and you say, hey guys, I tried my best, here's the keys, have a nice day. That's it. You're off the hook for whatever your loan is. If you're doing something illegal and not paying your mortgage, then you're on the hook. That's called the bad boy carve out. So other than that, it's but I jumped off topic. So that's the guarantor signs the non-recourse carve out guarantor. A key principal we define as someone who's just instrumental to the business. So it's a GP. It's usually one of the GPs in the property, the general partners who are just overseeing the asset and the deal. And they may only have 1% in the deal. So it's not a monetary designation. It's a involvement. That's someone that we define as a lender who's important to the process, a key person.
Got it. So it's more for management and executing a business plan rather than to debt servicing the loan kind of concept.
Exactly.
Got it. Right. Could the key principal also be the loan guarantor, and is that common?
Yeah, very, very common.
Okay, right on.
Yeah, usually the key principal is also the guarantor, or multiple guarantors or key principals. So, right. and then we have a term which is just principal. Which means that they're not involved in the day-to-day, but they own a substantial, they're just an investor, but they own 25% or more of the borrowing entity. We call them a principal.
Nice. Okay.
Nice.
Awesome. Great. Okay.
Yeah, great. All right. So one last question before we go to the next segment of our show. I know we got to all run here, so let's do this quickly.
Oh, yes. Yeah.
Nick, what are the predictions for the multifamily sector in 2022 and the next 5 years?
Oof. Oh, man. Okay. So 2022 looks really, really good. There's a lot of activity still in the multifamily sector. The agencies have caps that they're allowed to lend every year, and they raised those by about 12% for 2022. So they went from 70 billion each to 78 or something like that, $1 billion each. So they've actually increased their lending capacity. The agencies are supporting which means it's more liquidity. So they're allowing us to lend more money. So we believe that the multifamily sector is going to remain robust, very competitive, unfortunately for most of my clients. But there's a lot of liquidity out there, and multifamily it's a very good asset class. So it's very popular against unfortunately there's a lot of money allocators and funds and pension funds that are all in the space. So it makes it more competitive.
Yes, yes. Office space and also hospitality are coming into this space as well, as we're noticing it.
That's right. That's right. So yes, in the next 5 years, I think as rates are, we believe rates are going up. I believe rates I think we've come off the lows. And I think rates will be increasing over the next 5 years. I think that's going to put a lot of pressure on capitalization rates on deals. So I think, as cap rates have been compressing for many years, and rates were going down, so it still allowed investors to buy deals at higher prices. As that financing gets more expensive, and that the cap rate and the interest rates start to meet, it makes deals really very difficult to buy. And so I think what we'll see is, I think it'll slow down a bit. And I think sellers will have to catch up to the reality of that, that the hot market is going to, I think it's going to cool a little bit, but I think it'll maintain and be a very good asset class.
So the commonly used phrase that real estate is cyclical will eventually come into play, because currently is just on a high trajectory rather than being cyclical, but it will come back.
It'll come back. Yeah, I mean, it all comes down to returns, right? And so at some point your returns aren't going to be there, and the multifamily, and then people will stop buying multifamily and move to a sector that has good returns, risk adjusted returns, and then it'll be on the downturn, and so hence the cyclical.
Great. Okay, next segment of our show.
Real quick, Nick, we're going to do the 10 championship rounds to financial freedom. Whatever comes top of mind. Okay.
All right.
First question: who was the most influential person in your life?
Influential person in my life, probably my father.
All right.
Yeah.
What's the #1 book you'd recommend?
#1 book I'd recommend. Oh boy.
It doesn't have to be a finance book. It can be.
Yeah, no. One of the books that Mitch, Tuesdays with 𝗖𝗍.
Okay.
One of my favorites.
Tuesdays. What? Say that again.
Tuesdays with 𝗖𝗍.
𝗖𝗍.
Okay.
Okay.
Perfect.
Great book.
All right. If you had the opportunity to travel back in time, what advice would you give your younger self?
Buy Bitcoin.
Nice. Now, what's the best investment you've ever made?
Best investment I've ever made is in multifamily deals.
Awesome.
Yeah, I also invest.
Oh, fantastic. Okay. What's the worst investment you've ever made, and what lessons did you learn from it?
Worst investment I've ever made was in a tequila company. Okay. It's still around, but it has never produced anything, and it's been a lot of work. Would not recommend getting into the spirits industry.
Okay. Good. All right, next question. How much would you need in the bank to retire today? What's your number?
I don't know. I live a pretty simple life. Probably like, I don't know, 5 million.
All right. All right. If you could have dinner with someone dead or alive, who would it be?
I don't know. Martin Luther King.
Perfect.
Nice.
Now, if you weren't doing what you're doing today, what would you be doing now?
I would maybe teach.
Nice.
Oh, cool.
Nice.
Yeah, I'd be a teacher.
Nice.
Amazing.
Yeah.
My favorite question: book smarts or street smarts?
Me, street smarts.
Last question.
Definitely.
I love it. I love it. Street smarts all the way. If you had $1 million cash and you had to make one investment today, what would it be?
Multifamily.
All right.
Nice.
Yeah. Without a doubt.
That's a wrap. So just
Nick,
last
just last question. What's the best way people can get a hold of you?
They can email me at, I think you guys have it, but it's my work email is nicholas.diamond@lumint.com. And that's You want me to, I can spell it
Yeah,
out?
spell out
Yeah.
Lumen in case we turn this show to a podcast in the future. So people.
Yeah, sure. Well, so Lument is Lument. And Nicholas Diamond, Nicholas.Diamond, like the stone, Diamond, at lumen.com.
Awesome.
And happy to answer any questions from your supporters, your viewers. They have questions about, capital markets, loans, things like that. Always available.
Perfect.
Amazing.
Get in touch with Nick, guys. He'll
Absolutely.
he'll get you all set up.
And we say that
Awesome.
we say that firsthand. He'll take care of you.
Yes,
So
100%.
That's right. That's right.
thank you again. We really appreciate your wisdom. Thank you for taking the time. We know you have a very busy schedule, and we really appreciate it, man.
Thanks, Nick.
Thank you guys. This was a lot of fun. Appreciate it. We'll talk soon.
Sounds great. Talk to you
All
soon.
right. Bye-bye.
Bye.